Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Wednesday. And as we shared on the daily financial news, today's the day we speak with Anna REI mom, Kelly. How you doing, Anna?
I'm doing great. Good to see you.
Nice to see you as well. I always enjoy our conversations. We have we've been through the same stuff together, right? We kind of started at the same time, climbed the mountain, the recession happened, and all the stuff that's gone on over the last 20 years. But I'm kind of looking at a world that I really have. I mean, we probably experienced it as kids in the 70s, right? With the oil embargo in 73. And I remember my dad pushing the car because it was too expensive to wait in line. He would just push it as we move forward. I remember that. So
Wow.
we're thinking about new things today. So you've probably done some research, like what the heck do we do with our money, Anna? I just don't know. Let's go.
You know what I love is that we're real. We don't really know for sure because there's unprecedented times, right? So you kind of look back at history and say, okay, when this happened before, even though it's not exactly the same, how did people protect their money in the midst of inflation?
Yeah.
How did people protect their money in the midst of war? And we're facing both of those things, right? And so I think obviously there's lots and lots of different economists and financial advisors that all claim to know exactly what's going to happen and exactly what you should do. And I learned a long time ago, and I'm sure you have as well, that you can be really smart and know a lot of stuff, but it's the few things that change that you don't know that catch you by surprise, right? So we have to research and try to do the best we can to figure out what's the worst thing that could happen. How do I protect from that?
Mhm.
And maybe how do I make money if that does happen? So those are the things I'm thinking about.
Yeah. The other thing I just want to put out there as we debate this, the one area, there are some people that no matter what is going on in the world, the right answer is X. It's gold. It's crypto. It's foreign stocks. There are some people that no matter what happens, the answer is X. And I learned a long time ago certainly not to listen to those people, because you're going to be right twice, but you're going to be wrong a whole lot more.
Right.
So what I've tried to do over the last, month or two is I believed inflation was coming. And more importantly, I believed that the Fed was going to be weak. I think Jerome Powell is going to be Arthur Burns 2.0. And if you don't know who Arthur Burns is, he's the guy his tagline is called the Great Inflation. That's what he's known for. That's not good. And I think Powell is going down that path right now. It's like Arthur Burns 2.0. So I've been trying to figure it out because there's only so many things you could do, right? You can do commodities. So I've added some silver.
Yeah.
Not, less than 1%, but more than I had a month ago.
Right.
I had crypto for a while, but that's an insurance policy. 1% didn't add, didn't sell.
Right.
It is what it is. I have gone back to my real estate portfolio and de-risked my debt. That was something I absolutely did. I probably took $3 million in debt and put it on 30-year terms that, was naturally commercial debt. So I paid a little bit more, but at least I de-risked my portfolio.
Right.
And then again, I'm sitting on cash, and it just feels weird to say that because again, you got this cash is trash people. But I look at Warren Buffett and then I look at Jamie Dimon, and those two guys know that inflation is eating away at it, but they also know that when the tide goes out, there's going to be a lot of people in pain, right? Selling off assets, toys. And frankly, I think we've talked about this. I see the most pain coming in commercial. And I think there's a debt structure problem. There's bridge debt. There's unrealistic assumptions. There are still people calling for cap rates to collapse. I'm like, what are you thinking? And so, that's kind of where I'm at. And I don't know if it's right, but that's kind of what I'm doing. What are you seeing?
Yeah, no, that's all really good stuff. And, you talked about a few things. I mean, right now you're in mostly preservation mode, right?
Mm-hmm.
Let's preserve what we have. Warren Buffett's rule number one is never lose money, right? It's more important than trying to get more. And so we've been in this run up of greed since, 2010 and up. Mm-hmm. So for the last decades, people have only kind of seen the good. And they
Yeah.
saw us bailed out of, basically the pandemic and think, oh, well, if we survive that, everything else has to be better, right?
Yeah.
And I've learned, to your point, you have to de-risk in times where the economy is teetering or we're on the verge of recession. It's not the time to be, greedy when everybody else is. It's the time to go, okay, everybody's being greedy. We need to be a little fearful here, right? Not to keep us from moving forward, but looking at the negatives and saying, how do we hedge against that? Moving into preservation. When we're already at the bottom and you've got cash, that's the time when everybody's afraid to go, okay, now what am I going to go buy? Right. So to your point about there's this balance between preparing for the downturn, de-risking, and then having enough to capitalize when we have a downturn. And that's a really hard balance when you know that inflation is probably over 8% at this point, right? So you don't want to hold a lot of cash, but having lived through the Great Recession like we did, lived through the pandemic with eviction moratoriums with hundreds of units, right? We understand that when people can't pay, you still have to pay your mortgage. You still have to pay your taxes and the utilities. And if you don't have a lot of money saved up, you could go bankrupt, right? And that's what happens to people when they don't have enough. So I learned a lot through, 08. I mean, every time we had money, we put it down on another one. We put it down on another one. We never wanted to hold it. And now I'm going, I know holding cash is not great, but at the same time, I'm doing other things to, basically hedge inflation with assets that are going to go up in value, buying more real estate. So I'm okay using my real estate to hedge inflation and stay liquid so that if we do get a worse economy, and I think, we don't need a crystal ball to say it's here and it's probably going to be fairly bad fairly quickly. We've got some money to weather that storm. And I think that is what helps me to sleep at night, even in the midst of uncertainty.
Yeah. The one thing that I think because I look at what we're doing and we're kind of on the other side, right? But then I think about the new investors that watch this show. The one thing that I would tell them today, and it's back to my de-risking my portfolio. Anything that I did today, I would put on 30-year debt. I think if you brought me an apartment deal that I thought was a good deal and all I could get was 3 or 5 year debt, I don't think I'd do that deal. If it was a great deal, I probably do the deal, right? It's always a great day to do a great deal. Right. But I don't think I do a good apartment deal today. And I don't know that I would have said that 90 days ago. 90 days ago, I probably would have done a good apartment deal. 20, 30, 40, 50 units. I don't think I do a good deal today because I think there's a lot more headwinds in apartments than people realize. There's too many people that think it's the best thing to invest in. And that just makes me nervous.
Yeah, I see your points and I agree with you to some extent, and I have so many caveats, right? Because I've lived through so many things, right? But in general, especially you use the word new investors. If you're new and you're trying to get into the apartment space and people are telling you it's definitely going to weather the recession, prices will not come down in apartments, interest rates will stay low. They might raise them, but they got to bring them down. You can bridge debt is fine. If you're new and you don't have a lot of cash to weather interest rate risk and rates changing and values coming down and rents coming down, apartments is probably not the right place for you right now. Okay. Right. Yeah. So I agree with you there. For me, I think it all comes down to, just like with any investment, what are your financial goals? And does the particular deal that you're looking at move the needle in your financial goals and do it on a risk-adjusted return basis, right? So for me, when I look at value adds, right, and a lot of people want those value add apartments, we can come in, fix them up, hit a market rent, raise the rents, cut the expenses, and we create all this equity, and we hope we cash flow a little along the way. Sure. That model works really great in a rising economy and an expansion period. And that's what most newer investors in the last 10 years have seen. So they think that it's just going to keep getting better. And the real risk there is aggressive underwriting for investors who want that big upside and they want that cash flow. And they're overpaying today for that model because there's so many big institutional buyers who know the economy is teetering. Now that the market is rumbling, it's in correction territory, right? people want multifamily and commercial as a safe haven, a safe place to park money. They're in preservation mode. So they're willing to pay cash, Michael, and make a 2 or 3% cash on cash return. And all these investors say, oh, well, I'm going to outbid them. And then in order to make my numbers and cash flow and pay investors, I just got to be real aggressive. And I'm just going to assume that rates are going to come back down. And I'm going to assume that values are going to stay high. That's a ton of risk, right? So I won't do those kind of deals. But if I find a 10, a 20, a 30, a 50 unit property that is a nice buy and hold in a great area that's recession resilient, I'll do a good deal for the purpose of preservation of capital.
Okay.
Holding that thing over the very long term and knowing that these things last in cycles. And so if it's an area with the key is really recession resilient, good hospitals, good schools, low crime, lots of jobs and more people moving in than there is supply for, those are still good deals for me.
Sure.
Now, I'm not going to make a killing on them.
Right.
I'm not going to do a total renovation value add right now when supply chain issues and costs are high and long, right? But I'm going to hold that asset knowing that in the long term, they're pretty resilient.
Cool.
But if you can't afford to hold it and to your point, outlast the 5-year loan with some cash in case the rates go up, it could be a really risky thing for you. But I'm still positive on apartments when you buy the right kind in the right area with the right model and you eliminate bridge debt.
Yeah, you've got to, again, apartments are wonderful. They're great. I wish I had more of them, frankly. But I think for the average investor watching this, the ability, the pool of deals that kind of match what you've just outlined has gone very small. You got to be an elite investor to kind of identify them. And I unfortunately think there's a lot of new investors that are not reading the situation correctly and signing up for deals now that they're frankly guaranteed to lose money on.
And you have to be so careful. And here's the thing that a lot of people don't realize. In residential, there's a lot of protections for you as an investor, right? So you have state regulated realtor forms that protect the buyer in many different ways. You have seller's disclosures where you have to disclose everything wrong with the building, all the actual expenses. When it comes to commercial, there are not built-in protections. It's buyer beware. So every agent will pitch you deals on a pro forma, what they say the property could do in a perfect world, the rents you could get if you put so much money in, et cetera. And you're looking at those numbers thinking, oh, that'd be easy to get to that. It's not too far off from where we are. And so if you don't know what a difference is between current value and pro forma, and you overpay, or you don't understand the fundamentals of cap rates and net operating income and all of that stuff, you can look at something on paper and think this is an incredible return. But if you don't have the experience to do the level of due diligence you need to financially and market research and really know your market and know lending and all of that, you could be hurt and lose a lot of money. So you're better off investing with really conservative syndicators and taking lower returns for a nice buy and hold deal right now than these big value add deals. Or buy a small property for your own portfolio. Start with a duplex, a triplex, a 4-unit in a resilient area. And just know this isn't the time that you're going to make slam dunk cash flow. You're just not. You're just not.
Yeah. Yeah. And just to kind of wrap this up, what I'm looking to buy right now, I did a video on it, I think a couple of weeks ago. I have 2 buy boxes in my market of Fresno, California. Again, I'm not looking at anything commercial, so it's only 1 through 4s. I'd like to buy a portfolio, but that's what I'm looking to buy. And then in the city of Mountain View where I live, I'm actually looking to buy a small office building, somewhere between 500 and 1,000 square feet, just so I can stop paying rent. I want to own the building. So I like what I'm doing. So those are the 2 things I'm hoping to buy this year. So, yeah.
I love that. And here's the thing, even though there's a lot of people saying real estate's going to crash, real estate's going to fall, and we're going to talk about that a little bit later today, right? Generally speaking, well-placed residential real estate, houses, singles, duplex, small apartment buildings, and really strong areas weather recessions and inflation pretty well. And so if you invest for the long term and you're not trying to make a quick 2 to 3 year turn, with a lot of risk, if you invest for the long term, real estate's one of the safest things that you can invest in during inflation and during recessions, right?
Absolutely.
So I'm still investing heavily. I've sold a lot because I believe we're at the top, to some extent.
Mhm.
I've sold a lot, some of the loans that are coming due, some of the properties that need a little more work. But I'm holding that money and getting ready to buy more real estate, some silver, some gold, some real estate. Those are more of a hedge rather than hoping for growth and upside.
Mhm.
Is primarily what I'm looking at. I don't want to be in crypto right now. I've got a teeny tiny bit. I've got one stock. Not buying any more right now. If it goes a little lower, I might be tempted to buy a dip if we can figure out that it is the dip. But those are the main things that I want to be in is real estate, some gold and silver, and a couple of small stocks. I don't think that there's much better that you can invest in for the long term. And to your point, hold some cash.
Very cool. Well, Anna, do me a favor. How can people find you? Because you're putting out some amazing stuff.
Great. You can find me on Facebook, LinkedIn, and Instagram, Anna Kelly, REI Mom. My website's reimom.com. And you can also find me at greaterpurposecapital.com for investments in apartment communities where we make a difference.
Very cool. Thanks, Anna.
Thank you.